He is the quiet operator of macro trading, the man who bets on the world's turning points when others freeze. For over 35 years, he has capitalized on wars and financial crises, scaling more capital to over $15 billion at its peak, and in the process, making himself a billionaire.
If you look at Lewis's long-term track record, there is probably no trader alive who has better risk control on an asset base his size.
Louis Bacon is like an animal in his ability to sense the market.
From Carolina pines to the trading floors of New York and London, Louis Bacon is the patient predator who turns crisis into empire. America in 1956 pulses with post-war confidence. Suburbs explode across the map. Real estate becomes the new frontier, and the Sun Belt South rises fastest of all. Raleigh, North Carolina, stands at the heart of that boom. A capital city awakening to money, growth, and possibility. On July 25, 1956, Louis Moore Bacon enters this world of land and deals. His father, Zachary Bacon Jr., forges an empire. He founds Bacon and Company and later commands Prudential and Merrill Lynch's real estate operations across the state. The elder Bacon teaches his sons the rhythm of property: buy, improve, sell, repeat. Young Louis hears those lessons at the dinner table, rides along on site visits, watches deals close over handshakes. He learns early that land is never just dirt. It is leverage, timing, and nerve.
Louis was a boy who lived for the outdoors. He and his brothers vanished with their father into the Carolina woods and rivers every chance they got. Hunting, fishing, tracking game. He once spent an entire afternoon stalking a deer with his dad, learning the art of stillness. That same patience will later serve him on the trading floor.
In high school, he makes a bold move. Junior year, he transfers from local public school to Episcopal High School in Alexandria, Virginia, a place of iron discipline and elite networks. He sits in study hall while classmates play football, grinding through books when everyone else has escaped outdoors. And with that work ethic, he enters college. And with it, the discovery of markets that will become his ultimate hunting ground. The late 1970s grip America in stagflation. Oil shocks hammer the economy.
Historically, we have yet to have faced this type of a problem. There was always another mountain to climb. There was always another seashore to explore. There was always another desert to cross. There was always another Santa Barbara Channel to drill for oil. There was also always another great, vast Prudhoe Bay to be discovered. And all of a sudden, lots of things didn't happen.
Markets swing wildly after the 1973 crash, yet fortunes wait for those who can read the chaos. Louis Bacon heads north to Middlebury College in Vermont. He majors in American literature, devours Hemingway and Faulkner. He hunts, skis relentlessly, studies hard. But soon, he will meet someone that changes his life forever. One summer, he captains a sport fishing boat off Montauk, Long Island. The owner is Walter N. Frank, founder of Walter N. Frank and Company, a powerful New York Stock Exchange specialist firm. Frank spots something in the young captain. He offers him summer clerk jobs at his firm. Bacon grabs the chance. He shuttles between the boat and the trading floor, absorbing the rhythm of specialists making markets, the pulse of bids and offers, the raw electricity of real money in motion.
He met Walter Frank on that boat. Frank took a liking to him. Bacon spent those summers clerking at Walter N. Frank & Co., running tickets, watching the specialists work, and he saw how a single decision could move millions, and that experience lit the fuse. Frank didn't just give him a job, he gave him a window into a world most literature majors never see.
By 1979, Bacon graduates Middlebury with his B.A. in American literature. The markets have already hooked him. He sets his sights on Columbia Business School and wins acceptance into their MBA program. But soon, he will make a huge mistake he will come to regret. Columbia Business School in the early 1980s stands as the undisputed gateway to Wall Street. The program churns out future titans amid roaring volatility. Louis Bacon wins admission. He arrives in Manhattan ready to master the markets that have already begun to call his name. He studies finance with the same quiet focus like a hunter. But the classroom is only half the story. Bacon sees opportunity everywhere. He takes a low-interest student loan meant for living expenses and turns it into trading capital. Sugar futures, gold, cotton contracts. He bets on price swings he thinks he can read.
Commodity trading is brutally simple but also merciless. A futures contract is nothing more than a promise. I will buy or sell 1 shipload of sugar, 1 bar of gold, or 1 bale of cotton at this exact price on this exact future date. You don't need the full amount of money, just a small slice called margin. That tiny deposit lets you control a huge position. Think of it as the price you pay for the contract itself. If the price moves even a few cents in your favor, your profit is multiplied many times over. If it moves against you, the loss is multiplied just as fast. There is no sugar delivered to your dorm room, no gold bars stacked in the closet. You are just buying and selling these contracts instead of actually commodities.
But for the young Lois Bacon, the punishment is swift and unrelenting. For 3 consecutive semesters, he loses. Sugar turns against him. Gold collapses. Cotton follows. The account is wiped out again and again. Rent goes unpaid. Meals become a luxury. He stares at empty pockets and the mounting shame of having gambled money he was never meant to risk.
I took that loan thinking I had an edge, but 3 semesters straight I lost on sugar, on gold, on cotton, every single time. I had to call my dad and ask for spending money just to eat and keep a roof over my head. That was rock bottom.
Only in the 4th and final semester does the tide finally turn. He begins to win. He graduates with his MBA in 1981, bloodied but alive. The young man who once believed patience alone would carry him now understands the full weight of risk. And soon, he will accept a job that completely changes his life forever. Shearson Lehman Brothers emerges in the mid-1980s as one of Wall Street's most formidable powerhouses. In 1984, Shearson American Express acquires Lehman Brothers' Kuhn Loeb for roughly $360 million, creating a giant with 12,000 employees, massive retail brokerage, institutional trading, and M&A dominance. In 1983, Louis Bacon lands at Shearson Lehman as a futures broker. He executes client orders in financial futures, treasury bonds, stock index contracts, currencies, commodities. He runs a desk that handles billions in notional volume. His brother Zach trades for George Soros's quantum fund. His friend Paul Tudor Jones routes orders through him. Bacon becomes a top commission producer, earning millions in payouts as he matches buyers and sellers with precision and speed.
I learned how real money moved. You weren't guessing, you were executing for the smartest players on the street. Soros, Jones, they trusted the desk. That taught me discipline and the value of information flow. Every big order told a story. You saw the macro picture before it hit the tape.
He hones his macro instincts on the desk. He watches clients short the dollar in 1985 when it peaks, ride the bond rally in 1986. But for Bacon, it is not enough just to watch. The desk begins to feel too small. Bacon sees clients building empires with their own capital. He watches Jones and Soros print fortunes while he collects commissions. The itch grows. One day soon, he will walk away from the biggest brokerage on the street and bet everything on his own name. And soon, an opportunity will present itself.
Good evening, everyone. Well, the law of gravity hit Wall Street today, and financial markets around the world for that matter, as stock prices plunged even more than they did on Black Tuesday of 1929.
For years, Wall Street has been sitting on a powder keg. On Friday, October 16th, the Dow drops 108 points. Monday morning, October 19th, Black Monday, panic erupts.
Hour after hour today, wave after wave of selling hit the stock market. A selling panic, the professionals call it.
I just came from inside and it looks like a madhouse.
It's so crazy, nobody even expected it to be down this much.
The Dow plunges 508 points, a 22.6% wipeout, erasing $1.7 trillion in value in a single session. Selling feeds on itself. Computers execute unstoppable waves of sell orders. Louis Bacon has already begun to pull away from the broker's chair. In 1987, while still at Shearson, he quietly started trading with his own capital. He shorts stock index futures aggressively ahead of the crash, then flips long into the rebound. The single-day swing delivers over $1 million in profit for his book. Proof he can read the tape better than the clients he serves.
$1 million in 1987 was a considerable amount for anyone to have, and for Bacon, it's a sign that he should strike out on his own for good.
Emboldened, Bacon decides the time has come to strike out completely. He wants to manage his own capital, not just execute for others. The 1987 windfall gives him seed money and credibility. In 1989, using the $25,000 inheritance left by his late mother, plus capital from family and early clients, he founds More Capital Management, named after his middle name and his mother's maiden name. The firm starts with roughly $25 million and focuses on global macro bets.
Bacon's mother died in 1983, leaving him the $25,000 inheritance that became part of Moore's seed capital. His father later married the sister of Julian Robertson, the legendary founder of Tiger Management, one of the greatest hedge fund franchises ever built. Julian Robertson became Bacon's step-uncle. The blood tie brings instant credibility in elite circles. Robertson's network, reputation, and aura of excellence give the young macro trader a powerful tailwind at the exact moment he needs it most.
The young man who once hunted in deer through Carolina pines now tracks global inflection points with real money on the line. The real test and the real fortune begins now. Tensions simmer in the Middle East throughout 1990. Iraq, saddled with $80 billion in debt from the Iran-Iraq War, accuses Kuwait of overproducing oil and slant drilling into its fields. Saddam Hussein masses troops on the border.
The United States, the Soviet Union, Israel, and other powers are concentrating on diplomatic and economic solutions to this surprising and dangerous development.
More Capital Management is barely a year old. Bacon trades global macro from New York, London, and Hong Kong. Black Monday profits and Shearson reputation give him early credibility. By mid-1990, assets hover around $50 million. The fund posts solid but unspectacular returns. He just needs a one big trade that finally breaks through inertia. And he soon realizes that this Gulf War is the inflection point he has been waiting for. For Bacon, he realizes a clear thesis. Saddam will invade, disrupting supply and spiking prices. To profit from this incoming event, Bacon goes long crude oil futures and call options well before August. He pairs the bet with shorts on stock indices and the Nikkei, expecting risk-off flows. The trade is leveraged but disciplined, sized to survive if wrong. He monitors troop movements, OPEC statements, and satellite intel obsessively.
Thousands of Iraqi troops and hundreds of tanks crossed the border into Kuwait in the early hours of this morning. There's been heavy fighting in the capital Kuwait city and reports of large numbers of casualties on both sides.
Oil prices, hovering around $17 per barrel, explode. Crude surges to over $40 within weeks as the world fears supply cuts of 20% from the region.
Bacon read the intelligence and bet big on oil. He bought futures and options when crude sat at $17. When Iraq rolled in, prices doubled to $40.
The outcome is legendary. Oil positions deliver massive gains as prices peak near $40. More Capital ends 1990 up 86%. Assets swell from $50 million to over $200 million. Bacon's reputation soars. The macro maestro has arrived. In the early 1990s, Europe's exchange rate mechanism aims to stabilize currencies ahead of the euro's launch, pegging them within narrow bands to the Deutsche Mark. But tensions build as Germany's reunification drives up interest rates to combat inflation, forcing weaker economies like the United Kingdom to follow suit despite recessionary pressures.
At midnight, the West German flag, now the flag of all of Germany, was raised at the old Parliament building, the first act of a fully sovereign Germany of almost 80 million people, the most powerful country in Europe.
The British pound, overvalued at around 2.95 Deutsche Marks, becomes a prime target. On September 16, 1992, Black Wednesday, the Bank of England hikes rates from 10% to 12%, then promises 15%, but fails to defend the peg. Speculators hammer the pound, which plummets 15% against the dollar in days.
If it really is to be free fall, it will be the economic equivalent of bungee jumping.
There was a very, very small rally in sterling. It went up maybe a third of 1%, a very, very small rally for such a big rise in the interest rates, and immediately settled back on the floor. And the Bank of England was still buying pounds.
That afternoon, it became a veritable avalanche of selling.
Global markets convulse. European stocks drop 5 to 10%. Currencies like the Italian lira and Spanish peseta devalue by 20 to 30%. Bond yields spike amid capital flight.
Everyone just sat in stunned silence for about 2 seconds or 3 seconds, and all of a sudden it erupted and sterling just free fell. That sense of awe that the markets could take on a central bank and actually win, I couldn't believe it.
More capital management thrives by this point. Bacon's fund, started with $25 million in 1989, swells to over $1 billion in assets under management by 1992, fueled by the 86% Gulf War return in 1990. Bacon spots the exchange rate mechanism's fragility early. His thesis becomes clear. The pound's peg is unsustainable against high German rates and United Kingdom economic weakness.
The United Kingdom effectively abandoned its European currency peg, a decision made in the face of worsening inflation, increasing budget deficits, and a relentless attack by currency traders.
He anticipates intervention failure. He shorts the pound heavily, buying put options and selling futures at around $1.80 to $1.90 US dollars per British pound.
The ERM setup screamed misalignment. Germany's strength crushed the weaker links. We saw the pound as the weakest. It was classic macro, bet against artificial pegs when fundamentals diverge.
Executing via Chicago Mercantile Exchange futures and London International Financial Futures Exchange options, Bacon allocates $200 to $300 million to short the pound, including naked shorts and put spreads. As Black Wednesday unfolds, the pound's collapse from $1.90 to $1.50 generates 20 to 30% returns on positions. More nets $100 to $150 million overall from exchange rate mechanism trades, pushing 1992 fund performance to 45% and assets beyond $2 billion, solidifying Bacon's macro prowess. By the early 1990s, more capital surges. While Bacon takes advantage of the exchange rate mechanism trade, he also is eyeing an unprecedented opportunity in East Asia.
The Japanese economy is very much dependent upon the growth of the world economy. And since the world economy is not in a very good health, we still have a problem of the financial system.
Japan's economy staggers after its 1989 asset bubble bursts. The Nikkei has already fallen hard, but Bacon sees deeper rot, stagnant growth, banking weaknesses, and an overvalued yen. In 1992, he strikes. He shorts the yen against the dollar and other currencies via futures and options, building positions when the yen trades near 125 to 130 to the dollar. His thesis is clear. Japan's structural malaise will force devaluation. The trade is sized conservatively, hedged, and monitored obsessively. The yen weakens sharply. Bacon short delivers strong gains. Moore posts another blockbuster year, pushing assets well into the billions. The quiet Southerner now stands shoulder to shoulder with Soros and Robertson.
Macro trading at its core is betting on the big picture: economies, central banks, geopolitics, rather than single stocks. Bacon's style is pure discretionary. He reads news flows, studies imbalances, then places high conviction bets. Risk control is sacred. Cut losers fast, let winners run, never risk the firm. He trusts gut honed by years on the floor, but backs it with relentless analysis. Simple rule: understand the world better than the crowd.
But in the financial market, no one can win forever. Even the smartest people will get humbled. For Bacon, his reckoning is just around the corner. The early 1990s global economy recovers strong. Inflation stays low, growth accelerates, and central banks keep rates accommodative. Global bonds enjoy a powerful bull market. Yields fall steadily. In 1993, Bacon rides the wave perfectly, going long government bonds worldwide. More Capital posts a spectacular 53% gain. Assets swell. Bacon's conviction in a secular decline in rates grows ironclad. His thesis is simple and widely shared. With inflation tame and growth sustainable, central banks will hold or even cut rates further. He builds large long positions in United States treasuries, German bunds, and other sovereign debt, expecting continued price appreciation as yields compress. Leverage amplifies the bet, but sizing stays disciplined. In February 1994, the Federal Reserve, under Alan Greenspan, launches surprise rate hikes to preempt inflation.
If new data suggests it is likely that the pace of cost and price increases will be picking up, the Federal Reserve will have to act promptly and forcefully so as to preclude imbalances from arising that would only require a more disruptive adjustment later.
Short-term rates jump from 3% to over 6% by year-end. Bond prices collapse across the globe in one of the worst routes in modern history. More Capital drops more than 7% in February alone. The drawdown deepens. The year closes with a 14% loss, the fund's first negative return ever.
The market doesn't care how smart you are. Even the best get humbled. Bacon was long bonds like almost everyone else. The Fed moved faster and harder than anyone expected. And that's how fortunes are lost. When crowds is right until suddenly it isn't.
Bacon cuts positions ruthlessly and survives. But now he needs to find another opportunity to recoup, or his fund will fail just as fast as it rises. Southeast Asia in the mid-1990s looks unstoppable. The Asian tigers, Thailand, Indonesia, South Korea, Malaysia, post 8 to 10% annual growth.
I remember in the mid-80s, Thailand poverty rate was about like 30%. So 30% of the population, were poor. Today, it's down to 9%, right? So it took time, but there were people who actually were able to benefit from this growth.
Foreign capital pours in. Currencies are rigidly pegged to the dollar. Banks borrow cheaply in dollars and lend wildly at home. Real estate bubbles inflate.
Bangkok grew very quickly at that time as well because a lot of money was flowing into Thailand through loans from overseas.
More capital has clawed back from the 1994 bond massacre. After the 14% loss and mass redemptions, Bacon rebuilds with tighter risk controls. Bacon sees the fatal flaw. These economies are living on borrowed dollars behind artificial pegs. When the first domino falls, hot money will flee and the pegs will shatter. He starts shorting the Thai baht months before the break, then piles into the rupiah, won, and ringgit as contagion spreads. The positions are sized for asymmetric payoff. Limited risk if the pegs somehow hold, explosive gains when they don't.
Fixed pegs in emerging markets are accidents waiting to happen. Governments promise stability, but the math doesn't lie. Too much foreign debt, too little firepower. Bacon positioned early and let the cascade do the work.
And how? He waits.
Crisis hit, exposing the weakness of so-called Asian tigers. The East Asian economic miracle was no more.
In July 1997, Thailand's reserves run dry. The baht peg snaps. The currency crashes 50% in months. Panic spreads instantly. Indonesia, Korea, Malaysia collapse next. Stocks plummet 60 to 80%. Banks fail. Economies shrink violently. The Asian miracle becomes the Asian contagion. For Bacon, it is exactly what he's been waiting for. More Capital posts strong double-digit returns in 1997 and 1998, keeping annual performance in the 23 to 32% range through the crisis years. Assets recover fully and surge higher. The man humbled by the bond market has just delivered one of his cleanest, most decisive victories. And little does he know, a bigger storm is on the horizon, and this time he will be right there to capitalize on it. The world in 1998 is still reeling from the Asian crisis. Oil prices collapse below $12 a barrel as demand evaporates. Russia, struggling with post-Soviet chaos, piles up short-term domestic debt, GKOs, yielding 50 to 100% to attract buyers. Long-term capital management is the era's most celebrated hedge fund. Founded in 1994 by John Meriwether, with Nobel laureates Myron Scholes and Robert Merton, it raises $1.25 billion from elite investors. Using massive leverage, sometimes 25 to 1 or higher, LTCM runs convergence trades. Betting tiny spreads in bonds, swaps, and arbitrage opportunities will narrow. Early years deliver 40% plus annual returns with almost no volatility. At its peak, the fund controls over $100 billion in positions on just $7 billion of equity.
LTCM wasn't really macro trading, it was arbitrage on steroids. They made money by being right on small inefficiencies, then levered it up 30 times. It worked brilliantly until the world changed overnight.
Then, reality hits. On August 17, 1998, Russia defaults on its ruble debt, devalues the currency, and imposes a moratorium on foreign payments. The ruble plunges, global panic erupts, emerging markets seize up, credit spreads blow out to historic levels.
Crises in Russia are spreading to many regions in the world, including some of Russia's neighbor countries, Eastern Europe, Latin America, and South Africa.
It is the worst news for LTCM. Leverage turns modest losses into catastrophe. LTCM loses $4.6 billion in weeks, nearly 90% of its capital. The Fed orchestrates a $3.6 billion private bailout to prevent systemic meltdown. While LTCM implodes, Louis Bacon navigates the storm with precision. More capital avoids the relative value traps. Bacon stays directional. Long United States Treasuries in the flight to quality move. Selective shorts in emerging markets, and volatility plays. The fund posts strong double-digit returns, over 30% for the year, while peers bleed. Assets stabilize and grow again.
Bacon's edge was simple. He never bet the firm on tiny spreads. He traded big picture themes with controlled risk. When the world broke, directional macro won, and the leverage arbitrage lost everything. LTCM showed what happens when genius meets too much leverage. Bacon showed how to survive the same storm.
1998 becomes one of Moore Capital's most profitable years ever. Long United States Treasuries, in the flight to quality rally, selective shorts across battered emerging markets, and volatility trades deliver more than 30% for the flagship fund. Bacon's personal share of those profits alone adds tens of millions to his own account. The reclusive Southerner is suddenly worth several $100 million and still climbing fast. He was married to Cynthia Piggott. They have 4 children and divide time between a waterfront estate in Oyster Bay, New York, and the vast Robbins Island estate he quietly purchases and restores off Long Island. Bacon's real passion is land, buying, protecting, restoring. The same patience that once waited for deer in Carolina woods now waits for the right moment to lock up thousands of acres forever.
The stock market is founded on greed and fear and nothing else.
I think the internet technologies, the technology revolution has already
created an enormous amount of prosperity for all of us worldwide. I think that's just going to continue. There's no reason why we couldn't extrapolate that.
I think it was pretty clear by about 1999 that this was a bubble.
More capital sails through the dot-com bubble almost untouched. Bacon refuses to chase technology stocks. While the NASDAQ collapses 75% in 2000 to 2002, his fund stays positive, profiting from currency swings, commodity moves, and safe haven flows. The discipline that saved him in 1994 saves him again. In the early 2000s, the performance stays strong. Steady 20 to 30% annual returns, assets climbing toward $5 to $10 billion. Bacon keeps compounding through the post-September 11th world, the Iraq War oil spike, and the slow unwind of the housing boom.
Wall Street, this housing and credit bubble, was leading to hundreds of billions of dollars of profits, by 2006.
But the markets never rest. A far greater storm is gathering, and this time, it will shake the world to its core and push even Bacon to his limits. The American housing market in 2006 to 2007 looks invincible. Home prices have doubled in a decade. Subprime mortgages are handed out like candy to anyone with a pulse. Wall Street packages them into AAA CDOs and sells them worldwide.
Greatest bubble I've ever seen in my life, and I've read about bubbles all the way back to the tulip bubble. The entire American public eventually was caught up in a belief that housing prices could not fall dramatically.
Early cracks appear. Delinquencies rise. Two Bear Stearns hedge funds implode in mid-2007. But most of the world still believes the system is sound. More capital enters the period strong. After navigating the dot-com bust and the 2004 to 2006 commodity boom, the fund manages several $billion with steady 20 to 30% returns. Bacon has grown cautious. He reduces leverage, avoids heavy exposure to financial stocks, and keeps dry powder. He senses the leverage in the system, but does not go all in short subprime. He simply refuses to chase the bubble.
The Dow tumbled more than 500 points after two pillars of the street tumbled over the weekend. Lehman Brothers, a 158-year-old firm, filed for bankruptcy.
The storm breaks in 2008. The Dow drops 777 points in one day. Credit freezes. Global markets plunge. Banks fail or require trillions in government support. More capital weathers the chaos better than most. The flagship fund finishes 2008, down only 4.6%. A modest loss compared with the industry's 20 to 50% wipeouts.
That period was pure survival mode. Everything we thought we knew about risk and liquidity was tested. The only thing that mattered was not blowing up so we could still be in the game when the dust settled.
Bacon emerged standing, but the world had changed forever, and it will put everything Bacon has learned into question. The 2010s open in the shadow of the global financial crisis. Central banks unleash unprecedented quantitative easing, pushing interest rates to zero and flooding markets with liquidity. Volatility collapses to historic lows. More capital enters the decade battle-hardened. Since 1989, the firm has delivered legendary risk-adjusted returns. Annualized net gains of roughly 15 to 17.6% across its main funds, compounding into one of the greatest long-term records in hedge fund history. From the 86% Gulf War year through the Asian crisis wins, and the resilient 2008, Bacon has repeatedly shown he can read the big forces and survive the storms. But the rules of the game have changed.
So classic directional macro, the style Bacon mastered, struggles in the world of suppressed risk premium and crowded positioning.
Macro used to be about spotting the next big imbalance. In the 2000s, central banks removed most of those imbalances before they could matter. Low volatility, algorithmic crowding, and the dominance of passive flows made it brutally hard for even the best discretionary traders to find an edge.
For Bacon, it is the start of an end for him. After strong early 2010s performance, his returns turn inconsistent and low single-digit. Early 2010 losses, 2011 down 2.2%, 2018 roughly minus 6%. Assets shrink from $14 billion in 2010 to $8.9 billion by 2018, as clients grow impatient. And soon, he has to make a decision that feels inevitable.
Longtime trader and hedge fund manager Louis Bacon is planning to return capital to investors after 30 years of investment. The step to privatize more capital will mark the end of a storied era at the firm and follows years of weaker performance at the fund.
The trader who built one of the great macro empires over 3 decades now steps away from managing public capital. He sets up a family office to only invest his own money, and he is still rich beyond measure. But soon, the volatility will come with a revenge as a global pandemic is on the horizon, and Bacon will be right there to capitalize on it.
The U.S. is now the world's epicenter of the COVID-19 pandemic, and cases continue to multiply there. Tonight, there are more than 121,000 confirmed cases throughout America, and more than 2,000 people have died.
In late 2019, a novel coronavirus emerges in Wuhan, China. Within weeks, it spreads globally. By March 2020, the World Health Organization declares a pandemic.
We're deeply concerned both by the alarming levels of spread and severity and by the alarming levels of inaction. We have therefore made the assessment that COVID-19 can be characterized as a pandemic.
Nations lock down. Supply chains shatter. The S&P 500 crashes 34% in 23 days, the fastest bear market in history. Volatility spikes to levels not seen since 2008. The Fed slashes rates to zero and unleashes unlimited quantitative easing.
The Federal Reserve's emergency action to lower interest rates to near 0%, the first time since 2008, by the way, did nothing to prevent yet another Wall Street plunge today.
Markets swing wildly between panic and hope. More capital has been waiting for this moment. After the disappointing 2010s and the 2019 privatization, the firm now manages only Bacon's own capital and a small circle of employees. For years, low volatility and central bank dominance have starved classic macro traders of opportunity. COVID is the storm he has been waiting for.
Bacon's thesis was straightforward. He bet that a mix of huge government spending and a total market chaos would send everything from stocks to oil into tailspin. He essentially bet on the volatility itself. Early on, he loaded up on safe bets like treasuries and shorted risky bets, and played the swings in the commodities as the world shifted from lockdown slumps to stimulus spikes.
In 2020, the proprietary book delivers approximately plus 70% returns. Assets rebound sharply. The trader who endured a decade of muted performance has just posted one of the strongest single-year gains of his entire career. In 2025, inflation has cooled. The Fed has begun cutting rates, AI stocks drive new highs, but wars in Ukraine and the Middle East, United States-China tensions, and populist politics keep volatility alive. Global markets swing between optimism and unease. The macro arena is no longer quiet. Louis Bacon has come full circle. From a Raleigh boy tracking deer in Carolina pines to one of the greatest macro traders of all time, his journey spans 4 decades, 24 major market crises, and 2 personal divorces. Since 1989, his funds have compounded at roughly 15 to 17% annualized net, one of the most consistent long-term records in hedge fund history. Today, in 2025, his personal net worth stands near $1 billion. More Capital is a pure family office, managing his own fortune and a small circle of employee capital. He married conservationist Sarah Woodhead in March 2025 and continues quietly donating hundreds of millions to protect wilderness across North America and the Bahamas. Throughout his career, his strategy has been timeless and consistent. Discretionary global macro built on patience, discipline, and an almost preternatural feel for when the world is about to shift. He never bets the firm, cuts losers instantly, lets winners run, and trusts big picture forces over noise.
Louis Bacon is the last of true macro gunslingers. He doesn't chase trends, he waits for the moment when fundamentals and sentiments diverge violently, and then strike with surgical precision. That combination of risk control and almost poetic market intuition is why he has survived every storm that destroyed others.
In the world of macro trading, the greatest traders combine intuition, relentless training, and more than a little luck. You cannot win forever, but if you protect your downside and keep fighting, the next opportunity will always come. Louis Bacon has spent a lifetime proving exactly that.
We've just seen how powerful structured trading patterns can be when applied with discipline. If you want to go deeper into these kinds of systems, my friend Sandra, a professional trader, has put together a video outlining some very powerful trading patterns. There are no promises of extraordinary returns. It is all about structured setups, managing risk, and executing with consistency. Some traders use these systems to create profitable trades, and parts of it can even be automated. If you'd like to explore it, feel free to check it out. Link in the description.